There's a number sitting on your phone right now that nobody in your life has ever explained to you properly, and it just quietly decided how much your house costs, how much your car payment is, and whether your parents can actually afford to retire. It's not the Fed. It's not your bank. It's a silent, sprawling machine worth roughly $160 trillion, and 4 years ago, it went so haywire that it wiped out 16% of the safe half of millions of retirement accounts in 12 months. Almost nobody who owns a piece of this machine actually understands how it works. So stick around, because by the time we're done, you'll be able to look at any headline about yields or the Fed and instantly know what it means for your paycheck, your mortgage, and your future. Forget the Wall Street vocabulary for a second. A bond is nothing more than a loan with a receipt. Someone needs cash, and instead of walking into a bank, they walk straight up to regular investors and borrow from them directly. That borrower might be a Fortune 500 company, a mid-sized city building a new water system, or an entire national government. You hand over a set amount of money, called the principal, and in exchange, you get two promises carved in stone: a fixed interest payment every year, called the coupon, and your original money back in full on a specific future date, called maturity. That's genuinely the whole concept. What turns this simple idea into a force that reshapes your life isn't complexity, it's scale. No entity on the planet borrows more aggressively than the United States government, and the total national debt now sits above $36 trillion. A number that size stops meaning anything to a human brain. So let's shrink it down. Just the interest on that debt, not the debt itself, costs somewhere around $1 trillion a year. Break that into daily terms, and you're looking at roughly $2.7 billion leaving the Treasury every single day before a single school, road, or soldier gets funded. The government now spends more keeping up with interest than it spends on national defense. And here's the part that should actually bother you. Every cent of that comes from your taxes, and the rate the government pays is set by the exact same marketplace that decides your mortgage rate. Once you understand that connection, everything else clicks into place with one rule that never breaks. When interest rates climb, existing bond prices fall. When rates drop, those same old bonds become more valuable. It's a seesaw, and it never stops moving. Here's why that seesaw works the way it does. Say you buy a bond for $1,000 that pays you 3% a year, so $30 in your pocket annually. Then, a few months later, brand new bonds hit the market paying 5%, meaning $50 a year for the same $1,000 entry price. Now try selling your old bond. Nobody wants it at full price when a better deal just opened up next door. The only way anyone buys your bond is if you drop the price low enough that your fixed $30 payment suddenly looks like a competitive 5% return. Do the math, and your $1,000 bond is now worth about $600 on paper. Nothing about your actual payments changed. You still get your $30 a year. You still get your principal back at maturity, but your statement says you just lost 40%. That single mechanic, repeated across trillions of dollars, is the engine behind almost every so-called bond market crash you've ever heard about. Inside that massive bond universe, one single instrument acts as the master switch for nearly everything else: the 10-year U.S. Treasury note, which right now yields somewhere close to 4.4%. When your local bank sets your mortgage rate, they're not pulling a number from thin air. They're staring at that 10-year yield and asking a simple question: why would we lend you money for 30 years at a mediocre rate when we could lend to the government itself, risk-free, and get paid almost as much? So the bank takes that baseline 10-year yield and tacks on roughly 2 extra percentage points to cover the risk that you might lose your job, miss payments, or walk away. 4.4 plus 2 lands you almost exactly on today's national average for a 30-year fixed mortgage, right around 6.4%. Let's make this real with a person. Meet Daniel, a warehouse supervisor in Ohio who just got approved for a $380,000 30-year fixed mortgage at that 6.4% rate. Run the real amortization math, and his monthly payment for principal and interest lands at $2,376. Now imagine the 10-year Treasury ticks up by just half a point, something the bond market can do in a single volatile week. Daniel's mortgage rate climbs to 6.9%, and his new monthly payment becomes $2,503. That's an extra $127 a month, every month, for the next 360 payments. Stretch that across the life of the loan, and that one lazy half-point market wobble just cost Daniel roughly $45,500. Bump the move up to a full point instead of half, pushing his rate to 7.4%, and his payment climbs to $2,631, adding almost $92,000 total over 30 years. A bond Daniel has never heard of, let alone purchased, just quietly reshaped his entire financial life. Want to see how brutal this swing can actually get? Rewind to early 21, when 30-year mortgage rates bottomed out at an all-time low near 2.65%. At that rate, Daniel's exact same loan on the exact same house would have cost him around $1,531 a month. Fast forward to late 23, when that same rate spiked above 7.79%, and Daniel's monthly bill for that identical loan explodes to about $2,733. Same house, same loan amount, same person. The only thing that moved was a number on a bond chart, and the difference adds up to more than $430,000 across the life of the mortgage. The bond market handed Daniel a bill worth more than the house itself, and it never even sent him an email. For half a century, financial advisors told anyone nearing retirement the same tidy story. Sell your stocks, buy bonds, because bonds are your seatbelt. The classic 60-40 portfolio, 60% stocks and 40% bonds, was sold as the responsible, boring, grown-up move. Then 22 happened. The Federal Reserve hiked interest rates faster than at any point in over 40 years, dragging the benchmark rate from near zero to above 4% in under a year. Remember the seesaw. When rates spike, existing bond prices collapse, and that year the broad U.S. bond market fell roughly 13%, its worst performance ever recorded. Stocks dropped around 18% at the very same time, which meant that safe 60-40 portfolio lost close to 16% overall. The seatbelt didn't save anyone. It was bolted to the same car that crashed. And here's a comment worth sitting with for a second before we keep going. If the safe half of your portfolio can lose 16% in a single year, what does safe even mean anymore? Drop your gut reaction in the comments, because the next part explains why some bonds barely got scratched while others got demolished. Not every bond fell the same amount, and the reason comes down to one concept, so let's slow down here. The longer a bond's timeline stretched, the worse the carnage got. Intermediate Treasury bonds, the kind sitting inside most target-date retirement funds, lost around 10%. Meanwhile, long-dated zero-coupon Treasuries, the ones that don't pay any interest until decades later, plunged nearly 40%. Financial historians have pointed out that 22 was the worst year for long-duration U.S. bonds in over 2.5 centuries. The concept explaining all of this is called duration, and it simply estimates how much a fund loses for every 1-point rise in interest rates. Picture a retiree with $400,000 sitting in a bond fund with a duration of 6. A 1-point rate hike cost them around $24,000. Now picture that same retiree in a fund with a duration of 17 instead. That identical 1-point move wipes out $68,000. Before we go further, there's one distinction that changes everything about how scared you should actually be. So hold on to this. If you personally hold a bond until maturity, none of those scary price swings matter to you at all, because you collect every coupon payment and get your full principal back at the end, regardless of what happens in between. A bond fund, though, never matures. It's a constantly shifting basket, repriced every single day, and it only turns a paper loss into a real one the moment you actually sell your shares. If rates come back down later, that same fund's value can climb right back up, which is exactly what started happening as the Fed eventually eased off in the years that followed. The danger isn't that the loss is permanent. The danger is that most people panic and sell at the worst possible moment, which is what makes it permanent. That same fragility shows up somewhere else, too, just in a different disguise. Government bonds are treated as essentially risk-free because a government can theoretically print more currency, but private companies can go bankrupt, so corporate bonds have to offer a higher yield to convince anyone to take that extra risk. That gap between corporate yields and government yields, known as the credit spread, acts like an early smoke detector for the entire economy, often flashing warning signs months before headlines catch up. When investors get nervous, that gap widens fast, and money floods out of riskier corporate debt and into the safety of treasuries. That same flight to safety also explains why stocks and bonds don't always behave the way you'd expect. Normally, they move in opposite directions, cushioning each other so your whole portfolio doesn't fall at once. 22 broke that rule because surging rates hurt both asset classes at exactly the same time. This same relationship shapes something economists call the equity risk premium, which is simply the extra reward investors demand from stocks over the safe return of a 10-year Treasury. When Treasury yields climb, that premium shrinks, and money starts rotating out of stocks and back into bonds. Put all of that together, the duration risk, the credit spreads, the flight to safety, and you get one single chart that predicts recessions better than almost anything else. The yield curve, which maps Treasury yields across every time frame from 3 months to 30 years. Normally it slopes upward because lending money for longer periods should pay you more to compensate for the uncertainty. But when it inverts, when short-term bonds start paying more than long-term ones, a recession has historically followed almost every single time over the past 70 years. While all of this tectonic movement happens behind the scenes, your neighborhood bank is quietly paying you a national average savings rate of around 0.4%. Meanwhile, 3-month Treasury bills are yielding close to 4%, and top high-yield savings accounts are offering similar returns with the same government-level safety. Picture $40,000 parked in a typical checking account. That earns you about $160 a year. Move that identical cash into short-term Treasury bills instead, and you'd collect closer to $1,500 annually. Leave your money at a traditional bank for 5 straight years, and you've handed away nearly $7,000 in interest you were entitled to the whole time. Protecting your own future money means knowing the duration of whatever bond fund you're holding, treating anything above 7 as genuinely rate-sensitive, and anything above 15 as behaving almost like a volatile stock. If you specifically want protection against rising prices at the grocery store, Series 1 savings bonds offer a built-in inflation adjustment, and their current composite rate sits above 4%. The 10-year Treasury yield is essentially the check engine light for the entire global economy, and glancing at it takes less time than checking a text message. This isn't some exclusive game reserved for hedge funds and billionaires. It's the invisible pricing engine running underneath your rent, your car payment, and your retirement account right now. If this finally made the bond market click for you, hit subscribe so the next breakdown lands in your feed. Drop a like if you want more of these deep dives, and I'll see you in the next one.